We have reasonable confidence that 10-year will be slightly above 2% by the end of the year. In fact, that's more or less priced in by financial markets if you look at the futures and everything. So I don't think there will be much disruption there. Not to make light of the matter, we're just about 14, 15 basis points away. So the bigger concern is, of course, as you say, crude oil at 100. Now, we don't think you're going to get to 100 anytime soon because crude oil is now reasonably backward dated. And I suspect there's a little bit of too much of a strength in the near term. Having said that, the big magic number is 100 million barrels a day. And that is the global demand, daily demand for crude oil. And we're fast closing in on that. So energy demand, global demand is fast picking up. And that's basically pressuring, OPEC because they can't pump as much more, to keep pace with that. The other thing, of course, is geopolitical risk. We all know what's happening in Ukraine. And unfortunately, if it goes wrong there, then, that's going to push the energy complex, whether it's crude oil, gases, electricity, one more leg higher. And I think we know that we don't need that now.
Koon, German bond yield turning positive for the first time since 2019. Did that tell you that the inflation risk is starting to become synchronous and the ECB will be trying to play catch-up with the Fed in that regard?
So this is interesting. 10-year bonds are back above zero. Just something very interesting about Europe that's a bit different from the US. Inflation indicators in Germany, in Europe, right, Eurozone are back above 5%. And same for last night in the UK anyway. The interesting thing is inflation expectation, right, in Europe has not moved up that much. So there's a little bit of a lag. So I think the ECB will need to sit up once you see inflation expectations in Eurozone basically starting to pick up and move higher as well. But perhaps there's a lag of 3 to 6 months, but we need to watch that very closely.